dear CA final students. In this video, we are going to quickly revise Ind AS 28, investment in associates and joint ventures. So what is the standard about? See, if you are the investor of a company, X Limited is having investments in Y Limited. X Limited is having investments in Y Limited. X Limited, the investor, should prepare consolidated financial statements if Y is an associate or joint venture. If Y is an associate or Y is a joint venture, then X Limited should prepare consolidated financial statements. So how to prepare consolidated financial statements? So let's do it as per Ind AS 28. Okay. So first of all, what is an associate company? What is an associate company? Associate company is a company where investor have significant influence. If X Limited has significant influence over Y, then Y is my associate. So what is significant influence? Significant influence is the power to participate in decision making. It's not you have the decision making power, but you can participate in their decision making. So when can you participate in the decision making? When can you participate in the decision making of another company? One, if you are a shareholder holding 20% or more voting power. That is correct. 20% or more voting power. But you are a shareholder with less than 20% voting power. You can participate in the decision making if you have representation in the board. Representation in the board means in your study material illustration number 2 is that K Limited, Cuckoo Limited having 12% shares in Boho Limited. That is what question. Okay, so prima facie when I see 12% shareholding, there is no significant influence. But Cuckoo Limited has appointed 2 directors out of 8 directors. And each director is having 1 vote. So you need to identify, oh, then Cuckoo Limited is having literally 25% of votes. Yes or no? Even if percentage is only 12, 25% of voting rights Cuckoo Limited is having. Therefore, there is significant influence. Where what you are understanding, we are giving importance to substance over form. We are giving importance to substance over form. Okay. Now 3. You are a shareholder, say K Limited in B Limited, only 10% share. So K Limited is a shareholder of B Limited. Okay. But apart from that shareholder company relationship, there are material transactions between these two companies. Meaning, in the example, study material example, what they are telling us, K Limited is a shareholder of B Limited, and also K Limited acquires or procures 90% of output from B Limited. K Limited procures 90% of output manufactured by B Limited is material, substantial, significant. So K Limited is not just a shareholder. K Limited has significant influence. Okay, fine. So 5 cases are listed by our standard Ind AS 28, which can give significant influence to a shareholder. So first one is more than 20% voting power. Second one is representation in the board. You need to check how much voting share the company is getting. Then apart from a shareholder company relationship, there are material transactions which can give significant influence. Then interchange of managerial personnel. What is this? K Limited has 10% shares in B Limited. Okay. But K Limited has designated 2 of its managers to supervise the activities of B Limited. K Limited has designated two managers or their KMPs to supervise the activities of B Limited. So interchange of personnel, which can give significant influence to K Limited. Accordingly, if K Limited can participate because of that interchange of managerial personnel, if the investor is getting power to participate in decision making, then there is significant influence. and also essential technical information. What is this essential technical information? Again, K Limited is a shareholder of B Limited. Again, K Limited is a shareholder of B Limited, and K Limited provides some essential, very important technical information to B Limited. K Limited is a shareholder but provide essential technical information. Then K Limited is not just a shareholder. K Limited, if K Limited is having power to participate in decision making, there is significant influence. See, what are you talking about? What are you discussing? Okay, I'm discussing the areas where in substance, when an investor can get significant influence. I want you to learn this power to participate in decision making. You can get the power if you have more than 20% of voting power or representation in the board, or there are material transactions or interchange of managerial personnel and provision of essential technical information. Provision of essential technical information. Okay. Now, what is a joint venture? That we have seen in the previous video, right? As per Ind AS, which Ind AS? Ind AS 111. As per Ind AS 111, joint arrangement is a contractual arrangement between two or more parties to carry out an economic activity which is subject to joint control. And joint arrangement can be of two types, JO or JV. So if there is a separate legal entity, plus if there is rights over net assets and not individual assets, and economic independence, then if three criteria are satisfied, then it is a JV. Okay, I hope you have seen that last video where we are discussing what is JV. Okay. Now, okay, what is an associate? What is a joint venture? Associate is an entity where the investor has significant influence, and joint venture is an entity where investor has joint control. Okay. Now, okay, so we have investments in associate or joint venture. Then how to prepare consolidated balance sheet? So consolidated balance sheet is prepared as per equity method of accounting. We are following equity method of accounting. So what is to be done under this equity method of accounting? Under this method, on the date of acquisition, that is on the date of acquisition of investment, on 1st April if you invested, if the investments, say for example 40% shares you invested at rupees 1 lakh, then in consolidated balance sheet, recognize the investments initially at, recognize the investments at cost. Recognize the investments at cost. Recognize the investments at cost. Okay. Recognize the investments at cost. So you should show the investments at 1 lakh. Yes. On the same date, that is on the date of acquisition itself, compare the cost with the proportionate share of net assets, fair value of net assets of this associate company. Say for example, fair value of net assets is 3 lakhs. So as a shareholder who bought 40% share, 3 lakhs is the net assets. So you are having a share of 3 lakhs into 40%. 1,20,000. So 1 lakh you invested and the share of net assets you got is 1,20,000, which is resulting in goodwill or capital reserve. It is resulting in capital reserve. So on the date of acquisition, I invested 1 lakh, but I'm getting a share of 1,20,000. I'm super happy. Recognize that profit now itself. Recognize. What is the journal entry for recognizing that profits, capital reserve? I should pass the journal entry. Investment in associate or joint venture, account debit to capital reserve, 20,000. So eventually, on the date of acquisition, my investment will stand at 1,20,000, which is equal to share of net assets. Are you clear? Investment will stand at 1,20,000, which is equal to share of net assets. Okay. Now, what if the fair value of net assets is 2 lakhs? What if the fair value of net assets is 2 lakhs? What if the fair value of net assets is 2 lakhs? Then your share is 80,000. So you invested 1 lakh and the fair value of net assets is 80,000. Then what you should do? So you paid more PC. If you paid more PC, it has resulted in loss, that is goodwill. If more PC, it has resulted in loss, that is goodwill. So what should be the journal entry when it is goodwill? Should I reduce the value of investment? No, ignore. What? If there is goodwill, ignore it because on that date, goodwill is already there. Anyway, you pass the journal entry investment to cash, 1 lakh, or investment to whatever piece you have given. Investment to bank generally already passed. And your share of net assets is 80,000. So now, listen, investment value is equal to, investment value is share of, I'm sorry, investment value is equal to share of net assets plus goodwill. Share of net assets 80,000 plus goodwill is equal to investment. So goodwill is already included in the investment. So don't include it again. Ignore. Once more. On the date of acquisition. Okay. If you are preparing consolidated balance sheet, show investments at cost. Okay. So there is no other change. SFS and CFS, investments to bank. But in CFS, you compare it with the proportionate share of net assets. What is the share I am getting on the date of investment? Okay, so I compared it and it is a loss, goodwill, then ignore it. No need of an additional entry, investment value already includes goodwill. If it is resulting in capital reserve, on that date itself, if there is a capital reserve, then pass the journal entry, investment to capital reserve. Okay, now on the date of acquisition, that's it. On the date of acquisition, just recognize investment at cost, compare it with the fair value of net assets, proportionate share of fair value of net assets. I hope that is okay. Now, at the end of each reporting date, so 1st April I acquired, 1st April I recorded investment at cost and compared goodwill or capital reserve, I know the accounting. Now, at the end of each reporting date, at the end of first year, identify what? Post acquisition profits or OCI of associate or joint venture, which is to be added to the carrying value of investment or cost of investment. So what does that mean? Subsequently, on the date of acquisition, say for example, if date of acquisition is 1st April 2025, first year end 31st March 2026, whatever profits earned by the associate or joint venture during that 1 year, of that 40% right is with the investor. Yes or no? So you should identify what are the post acquisition profits earned. It can be reserves, it can be retained earnings, it can be statement of P&L profits, or it can be revaluation reserve, it can be actuarial gain, it can be fair value reserves, FCTR, whatever. Whatever post acquisition profits or losses of the associate company, you should, assuming it is profit, we'll pass the journal entry, write entry here. What is the entry? Investment account debit, debit investment in associate or joint venture to associate or joint venture to, if they earned profit, to P&L. Only, we'll take only the share, our share. If they earned OCI, revaluation reserve, we'll take our share of revaluation reserve. If they earned FCTR, we'll take our share of FCTR. If they earned reserve, we'll take our share of reserve. So if they have a reserve, same reserve will appear in our books, but only to the extent of our share. So here there is a cloud. What is to be written? Only investors' share. Only investors' share is taken over. Plus retain same classification. Retain same classification of reserve. Retain same classification of reserve. Okay, fine. So at the end of, once more let's read, at the end of each reporting date, the share of post-acquisition profits or OCI of associate or joint venture is to be added to the investment. We'll pass the entry investment account debit to whatever profits they earned. We'll take our share. So only investors' share is taken over and we'll retain the same classification of reserve. Pakka. Now, any distribution received from associate, subsequently your associate has paid you. You earned 100 rupees profits. Associate, now say for example, associate earned 100 rupees of profits. You will be taking over 40, being your share, 40%. Now, out of this 100, they declared and paid dividend 50. So, associate will receive 50. 50 into 40%. So, once more. Now, say for example, your associate has earned a profit of 5 lakhs. Okay. Of which your share is 40%. So, you'll pass the entry investment in associate 2 lakhs to P&L 2 lakhs. Subsequently, your associate company has declared and paid a dividend of 2 lakhs, of which 40% will be received by you. Yes or no? So what is the journal entry? If the associate has declared dividend and paid dividend, then what is the treatment? That is what next. Any distributions. So that is our next point. Any distributions received from associate or joint venture is deducted from the carrying value of investments. Is deducted. Is deducted from the carrying value of investments. You will be passing the journal entry. What will be the journal entry? If you receive dividend, bank debit, or dividend declared, dividend receivable to investment. But what is the logic? Why you credited investment? Because the logic is you already added your share 2 lakhs. You already added 2 lakhs as your share. So your investment value is more by 2 lakhs. From that you recovered 80,000. It's like you are adding all receivables to investments. All receivables, all the share of profits you are adding to the investments. So investment represents what is receivable from associate. Investment represents what is receivable from associate. When you receive it, it is like recovery of investments. It is like recovery of investments, bank to investment. Can I do bank to P&L? No. Again, what is the reason? Already P&L is credited with your share. If you again credit it, it is duplication. It will result in duplication. Are you understanding? So any distributions received from associate or joint venture is to be deducted from the carrying value of investments. Okay. Now just 3 more points. With that, the standard is done. Okay, just 3 more points you have. With that, the standard is done. The important points of the standard is done. So what is this? Question number 5. Sure. So what is this point number 5? Any long-term interest in investee. Any long-term interest in investee. And the settlement of which is neither planned nor expected to happen in foreseeable future, then it is in substance investment and should be added to the carrying value of investment in associate or joint venture in CFS. No idea. What is this? That is, if you have invested, A Limited has invested in equity shares of A Limited has invested in equity shares of B Limited, say 40%. And you invested 5 lakhs. Okay. Now, A Limited has given a loan to B Limited. How much? 3 lakhs. Loan is given to B Limited. Okay, 3 lakhs loan is given to B Limited and its repayment is, so any long-term interest, a long-term loan or investments in bonds or investments in debentures of associate or joint venture, and the settlement of which is settlement, we should repay it, and the settlement is not planned nor expected to happen in foreseeable future, which means in near future that repayment is not going to happen. So in substance, in consolidated financial statements, it should be added to the carrying value of investment in associate. It should be added to the carrying value of investment in associate or joint venture in CFS. Okay, any long-term interest, any long-term loan, long-term investments in preference shares or bonds, then that is to be in substance treated as investment in associate if the repayment is not planned nor expected to happen in foreseeable future. So there is a study material illustration number 15 which is very good. You need to do that. We'll try that illustration 15. Very good illustration which has not come for exam. We are expecting. Now, the carrying value of investments in consolidated financial statements. Carrying value of investments of associate or joint venture in consolidated financial statements shall not be negative. So, is there a chance that it can become negative? Yes. Your investment cost is 1 lakh. Okay. First year, the company has made or incurred a loss of 10 lakhs, of which your share is 40%. So it's a loss. They have suffered a losses of 10 lakhs and your share is 40%. So your share of loss is 4 lakhs. So your investment can show a negative figure. It cannot be shown at a negative figure. Investment can be shown only at a nil value. Maximum nil value. So let's read this. What is given? When the share of post-acquisition losses of investee, when the share of post-acquisition loss of investee exceed beyond its carrying value, then it can be recognized as a liability. So 3 lakhs negative can be shown as a liability only when the investor committed to pay the obligation on behalf of the entity as per an agreement. What is this? Investor. That is A invested in B and there is a loss of 10 lakhs. So my share is 4 lakhs but my cost of investment is only 1 lakh. So if I take that 4 lakhs, my investment carrying value becomes 3 lakhs negative. So negative means 3 lakhs credit balance. Show it as a liability only if A has entered into an agreement with B and committed to pay the obligations of B. B, your obligations will be paid by me. Don't worry. Have you entered into an agreement like that? Then A is having liability. So if you have not entered into any such agreements, investments should be reported at nil value. Okay. If the investment is reported at nil value, then profits can be subsequently reported only after the share of profits equals to share of unabsorbed or unrecognized losses. Oh, that is not clear. This point number 5 and 6. Please wait. We'll quickly do that or discuss that question number 5. Question number 15. Let's quickly discuss that question number 15 and trust me, it will be perfect. These points will be very clear to you. Okay. Now, last one. What is the treatment of unrealized profits or losses? So, you need to remember in consolidated financial statements, in consolidated balance sheet, assets and liabilities of associate or joint venture will not be taken over. Oh, in consolidated balance sheet, assets and liabilities of associate or joint venture will not be taken over. Hence, mutual owings are not cancelled. Why I didn't understand the concept? See, instead of taking over your share of assets and liabilities, you are showing investments. And investments represents your share of net assets. Your share of net assets is what shown as investment. So don't take over any asset or liability, and because you are not taking over any assets or liability, mutual owings. Sometimes question will give you information about mutual owings, but mutual owings will not be cancelled. But investors share of URP is cancelled. Unrealized profit, if any, then investors share of URP is cancelled. So only investors share of URP is cancelled. So what is the journal entry when you cancel? Okay, study, learn. If it is downstream transaction. So what is downstream transaction? Downstream transaction is nothing but investor selling to associate or joint venture. So investor selling to associate or joint venture. So investor sold to associate or joint venture is downstream. So if it is downstream transaction, there is URP in the closing stock. URP in the closing stock. Correct. URP in the closing stock. But closing stock is in the books of associate or joint venture. Closing stock is in the books of associate or joint venture. Are you taking over? No, we are not taking over. So in such a case, associates or joint venture stock should be deducted. But we are not taking over, hence it cannot be deducted. So what is the journal entry for cancelling URP? What will be the journal entry for cancelling URP? P&L to investment in associate or joint venture. So guys, understand investment account represent the net assets of the associate or joint venture. If associates or joint venture stock is to be reduced means investment is to be reduced. Okay. Only our share of URP is to be deducted. Investors share of URP. So that is URP into investors share. I take only my share. Okay. Now, if it is upstream, what is upstream transaction? Associate or joint venture selling to investor. What is the entry for cancelling URP? P&L 2. Stock is lying in which company? Stock is lying in which company? If upstream transaction, stock is lying with investor. So we'll pass the entry P and L to stock. Our stock. Associates or joint ventures, net assets are not affected. Our stock is affected. So P and L to stock. So URP into investors share. So the connection between the investor and associate is only to the extent of that investor's share. Only investor's share. Okay, we'll take over only our share of profits. Investor's share will be taken over. URP cancelling, only investor's share will be cancelled. Okay. So what if it is unrealized losses? Unrealized losses can be eliminated only if A sold to B. If A sold to B. A is the investor, B is the associate. A sold to B 100 rupees item at rupees 80. 100 rupees item sold at rupees 80 at a loss. And stock is still lying as closing stock. Can you cancel it? Unrealized losses can be eliminated only if cost is recoverable. If sold to an independent party in the external market. Not clear. Can you explain once more? Yes. A sold to B 100 rupees item at rupees 80. But instead of B, if A sold to an outside party, were you able to sell at 100? Yes. Okay. If that is the case, then URL has to be eliminated or reversed. If to the external party also I can sell only at 80 because the NRV is less now, then that loss cannot be reversed. It is an actual loss, not out of intercompany transactions. I hope that is okay. So unrealized losses can be reversed only if the cost can be recovered if sold to an independent party in the external market. So these are the points while preparing consolidated balance sheet. So let's try few questions from the study material. And so we'll see some questions from the study material. On the first day of a financial year, A Limited invested in the equity share capital of B Limited at a cost of 1 lakh to acquire 25% of shares in the voting power of B Limited. So what will be the journal entry? Investment to bank 1 lakh. Okay. At the end of the year, B Limited earned profit of 10,000. B Limited earned profit of 10,000 and other comprehensive income OC of 2,000. So what is the entry? Investment to P&L 2,500. Investment to OCI 500. In that year, B Limited also declared dividend to the extent of 4,000. So you already added the entire share of profits to your investment. Then you get 4,000 into 25%, 1,000. What should be the journal entry? Just have a look. Investment in B Limited to statement of P&L 2,500. Investment in B Limited to OCI 500. Now declared dividend receivable to investment 1,000. So your carrying value of investment will be 1 lakh plus 2,500 plus 500 minus 1,000. 1 lakh 2,000. Okay. So now we'll do this question number 12. We'll do this question number 12. Entity A holds 20% of equity interest in entity B as associate that in turn has 100% interest in entity C. So entity A in B has 20% share. B in C has 100% of share. Okay. Entity B recognized net assets relating to C 1,000 in consolidated financial statements. Okay. Entity B recognized net assets relating to entity C. Entity B recognize net assets. So entity C is having a net assets of 1000. B being the holding company, B has entire net assets. And entity B, that is this holding company, sells 20% of interest in entity C to a third party. So you need to have an idea about the accounting of disposal of shares in subsidiary as per Ind AS 110. What is the accounting when the subsidiary's share is disposed? Subsidiaries share is disposed without loss of control. Partial disposal without loss of control. What is the entry? What will be the journal entry? Bank account debit. You got a bank of 300. Bank balance increase 300. To NCI will come in consolidated balance sheet. How much is the amount of NCI? If net assets is 1000, 1000 into 20% is NCI's share, 200. To gain or loss is transferred to before control, after control. There is no loss of control. Gain is transferred to other equity. Other equity. Okay. So entity B sells 20% of interest in entity C to a third party, that is NCI, for 300 and recognized an equity transaction resulting in a credit of, credit of 100 to the entity B's other equity. Okay. The financial statements of A and B are summarized as before. So they have given some balance sheet where before A has investment of 200. Correct. Current B is having a net assets of 20% of net assets of 1000. So investment in B 200 and corresponding share capital 200. Before position, before sale, holding company's position, assets from C we have taken over. There is no NCI. So same they have shown as the share capital. Now equity side. Now after position, here what has happened? A bank balance will increase. Yeah, that is what 100. NCI will come. Yes, NCI 200. And other equity profits increased 100. Now, although entity did not participate in the transaction, entity A's share of net assets in entity B increased as a result of sale of B's 20% interest in C. Effectively, A's share in B's net assets is now 220. What is this? I didn't understand. Earlier, B's net assets was 1000. So your share was 1000 into 20%, 200. Now B's net assets is 1300 minus NCI. So 1100 is the net assets. So 1100 into 20%, 220 is the share of net assets. So investments should increase by 20. So how this will be accounted? See how this will be accounted. What we will do is we are following equity method of accounting where post acquisition increase in profits. There is an increase of other equity 100. So we'll pass the journal entry investment account debit 20 to other equity 20. P&L or OCA, you should always retain the same classification. So this is the only entry to be passed. This question is very lengthy, but the answer is very easy. What is given here? The changes in interest in the net assets of the associate as a result of the sale. Okay, fine. It is not reflected in P&L. Therefore, thus in the given case, entity A recognizes 20 as changes in. If associates other equity increases means investors other equity should increase and not always to statement of P&L because it should maintain the same classification of reserve of the associate. So direct credit to equity in the consolidated financial statement. You should pass the entry investment to other equity. The journal entry required is investment to other equity and not investment to P&L. Such an easy question and answer, but the question seems to be very lengthy. Okay. Now this question number 15. An entity has following three types of interest in associate. Equity shares, 25% of the equity shares to which equity method of accounting is applied. Okay, you have investments in 25% of equity shares, equity method of accounting is applied. Preference shares, non-cumulative preference shares that form part of net investment in associate. Okay, in separate financial statements, it is investments in preference shares of associate, but in consolidated, you should add that preference shares to the carrying value of investments. It should be added to the carrying value of investments. So such preference shares are measured at fair value as per 109. Okay, so in the separate financials, as per 109, we will be accounting it. There is a long-term loan. The loan carries interest at the rate of 10%. The interest income is received at the end of each year. The long-term loan is accounted as per amortized cost as per Ind AS 109. Okay. The loan also forms part of net investment associate. Okay. So here what they are trying to tell you, that is, there is investments in equity shares, there is investments in preference shares, there is a loan. All this together will form the carrying value of the investments and associates in consolidated balance sheet. Okay. At the start of the year, carrying values are given 10 lakhs, 5 lakhs, 3 lakhs. Following table summarizes the changes in the fair value of preference shares as per 109, impairment loss on long-term loan, and entities share in P&L of associate for the year 1 to year 5. Okay. So first year, fair value of preference shares reduced, or in the separate financials, it was preference shares 5 lakhs, but it is 4 lakh 50,000. Impairment loss, oh, 3 lakhs, so there is an impairment loss, so the carrying value will be 2 lakh 50. And there is a 16 lakhs entity's share of loss. Entity's share of loss. Associate has made a loss of which the entity's share is 16 lakhs. Then again there is next year decrease in the value of preference shares, 2 lakh share of loss, 1 lakh increase, impairment loss reversed, then 50,000 increase, 30,000 increase and share of profits. Throughout year 1 to 5, there has been no objective evidence of impairment in the net investment in associate. The entity does not have any legal or constructive obligation to share the losses. So you can report the investment account at nil value. Based on the above, determine the closing balance of each of the above interest at the end of each year. So what are the steps to be done? So instead of discussing, very quickly, I'm solving it. So this is a question which has not come for exam. So anytime it can be asked. So we'll give one particulars column, investments in equity shares, preference shares, loan and total. Okay. So first, year 1. So carrying value of investments, year 1, opening balance given. So this is investments in equity shares, investments in preference shares, loan and total. So opening balance given is 5 lakhs, not 5 lakhs, sorry, 10 lakhs, 5 lakhs and 3 lakhs. So total is 18 lakhs given. Okay. First, you should do adjustment as per 109, because before coming to consolidated financial statements, adjustments as per 109 in separate financial statements are to be done. So, preference share value reduced by 50,000. Loan value, there is an impairment loss of 50,000. So, the value of the investments are already reduced by 1 lakh. And current year share of loss. How much is current year share of loss? 16 lakhs. Loss will be adjusted. Equity shares 10 lakhs. Okay, so there is a negative 6 lakhs. But in consolidated financials, you show preference shares and loan as a part of the carrying value of investments. So you will adjust 10 lakhs to equity shares. You can adjust 4,50,000 loss to preference shares and balance 2,50,000 loss to loan. Okay. So closing balance at year 1 nil 1 lakh. So here it is 1,50,000 balance. So closing balance is nil, and 1 lakh. Are you understanding this? If there is a loss, first you adjust the loss against equity shares, then you adjust the loss against preference shares, and then against loan. Equity shares, preference shares, if there was debentures, then to debentures, then to loan. Okay, fine. So this is the closing balance of investments in the first consolidated balance sheet. Okay. Now year 2. Year 2, first opening balance. Okay. Now adjustment as per Ind AS 109. So when I check the question, year 2, what is happening in year 2? In year 2, preference share value again reduced. Current year share of loss is 2 lakhs. Preference shares value reduced by 50,000. But if I adjust 50,000 loss, then preference shares will show a negative figure. Yes or no? It will show a negative figure. So that should not be done. Therefore, what is to so that should not be that in preference share value should not be negative. Therefore, reverse the share of loss already adjusted. Share of loss adjusted in year 1. In year 1. So 50,000 we'll reverse and adjust to loan. Okay. Then current year share of loss. Current year share of loss is 2 lakhs. Current year share of loss is 2 lakhs. But there is no balance with equity shares. There is no balance with preference shares. There is only a 50,000 balance left in loan account. So current year share of loss 50,000 will be adjusted So we'll write a note. Unabsorbed loss rupees 1,50,000. Unabsorbed loss will be there 1,50,000. Closing balance is nil. Are you getting? Closing balance is nil. So I reverse the loss already adjusted to preference shares, and there is balance in loan, therefore I adjusted against loan. What if there is no balance in loan? Then that too will remain as unabsorbed. That's it. So there can be unabsorbed losses. Unabsorbed losses 1,50,000. Okay. Now what is happening? Year 3. Year 3. Opening balance. Nil, nil, nil and nil. Oh. Adjustment as per 109. Adjustment as per 109. Preference shares reported a fair value gain. Loan, a loss already, impairment loss already written off has been reversed. And there is no profit, no loss. Okay. So that as per Ind AS 109, not this. Preference share value increased by 1 lakh. Loan balance increased by 1 lakh. So we got a carrying value of 1,50,000 against which previous year less. There is no current year loss. Previous year unabsorbed loss. 1 lakh and 50,000 will be adjusted. Okay. Nil, nil, nil. Good. Now year 4. What is happening in year 4? What is happening in year 4? Opening balances are nil. Adjustment as per 109. Adjustment as per 109, 50,000. And current year there is a profits, 10 lakhs. So preference shares increased by 50,000. And current year profits. So is there an unabsorbed loss? Nothing, no unabsorbed loss to adjust. So entire 10 lakhs we can distribute to the carrying value of investments. How I'll do the distribution? How we'll do the distribution? In the reverse order. In the reverse order means first we need to check how much loss was adjusted against loan. So please focus how much loss was adjusted against loan. First year 1,50,000 loss. Second year 50,000 preference shares, that reversal of loss, and also current year loss, total 1 lakh. So 1,50,000 plus 1 lakh, 2,50,000, 3 lakhs. Third year 3 lakhs. So total loss adjusted to loan is 3 lakhs. So profits will give 3 lakhs. Okay, then preference shares. Preference shares. First year we adjusted a loss of 4,50,000. But second year we reversed a loss of 50,000. So 4,50,000 minus 50, 4 lakhs plus 1 lakh. So total loss adjusted was 5 lakhs. So we'll also reverse 5 lakhs. And balance 2 lakhs. Balance 2 lakhs to equity shares. Okay. So it is 2 lakhs, 5,50,000, 3 lakhs. So 10 lakh 50,000. Okay. So is there a doubt why last? Because equity shares losses will be first adjusted against equity shares. Profits will be last share will be given to equity shares. Okay. And lastly, year 5. Opening balances 2 lakhs, 5 lakh 50, 3 lakhs. So 10 lakh 50,000. Adjustment as per 109. Is there an adjustment as per 109? Preference share value increase 30,000. So preference shares value increased by 30,000. Okay. Then share of profits. 10 lakhs. Share of profits. How much to loan? Nothing. Because whatever loss we adjusted, we have reversed. How much to preference shares? Whatever loss we adjusted, we have reversed. Balance entire profits should be adjusted to equity shares, added to equity shares. So closing balance is 12 lakhs, 5 lakh 80,000, 3 lakhs, and 20 lakh 80,000. See, this I personally feel this is easy because the conceptually, yeah, first always the loss should be adjusted to investments in equity share. But if there is a long-term interest, it can also form part of carrying value of investment. In case of loss, that loss can be adjusted to such investments. But if there is a profit, whatever loss we adjusted to that particular loan or preference share, to that extent, profit, if there is profit, it can be reversed. Otherwise, profit is always added to equity shares. So here, the points what we are learning is, the points what we need to understand is, so points what we are learning is, any long-term interest in investee and the settlement is not planned, not expected to happen in foreseeable future. In substance, it is considered as investments in associate or joint venture in CFS. And carrying value of investments cannot be negative. So when the share of post-acquisition profits or so all of you read, when the share of post-acquisition losses of investee exceed beyond its carrying value, then it can be recognized as liability only when the investor committed to pay the obligation on behalf of entity. If the investment is reported at nil value, okay, then profit can be subsequently reported only after share of profits equals share of loss, share of unabsorbed or unrecognized losses. Okay, that 2 points should be clear. Subsequently, you can add profits only if there is no unabsorbed losses. So that's it, guys. In May 2024, we got a question of full set consolidated balance sheet of associate. A video has already been done on May 2024 exam paper, so which we are not trying. This is a quick revision of Ind AS 28. I hope this is clear for you. If there is a doubt, you please comment below. We'll meet with the next video. Thanks for watching. Take care. Bye.